Hello, everyone. My name is Usha Srinivasan, and I am a data scientist at Credit Analytics at Ford Motor Credit Company. And today I'm going to talk about CECL IFRS9 implementation processes that we have gotten working at Ford Credit, collaborating with SAS. And I'm going to talk about drivers for quarter-over-quarter change in allowance. I'd like to first start off with some acknowledgements. The team I work with, Maria Mutuk-Hensley and Jill Buick, who's our manager at Ford Motor Credit Company, as well as our collaborators at SAS, Gaurav Singh and Danny Knoll. I'd also like to acknowledge Yilu, who is our director at Credit Analytics at Ford Motor Credit Company, our business partners, Susan Maybury and Shlomo Kleinman, Margaret Mallet, who is our global communication manager, as well as Rahul Reddy, who helped us with the IT infrastructure and implementation of this IFRS9 variance process that I'm going to talk about today. So with that, I'm going to briefly go over the outline of my presentation. I will be going over the CECL IFRS9 background and model framework, talk about overview of the different attribution methods, including loan level methodology for variance attribution, as well as the weighted average variance attribution. I will then briefly go over comparison of methods and talk about business insights and conclude with some summary. So as a lot of you may already be aware, the IFRS9 CECL process for expected credit loss calculation requires us to go over from through the cycle process for calculating the expected credit loss to a point-in-time process. And this happened because in the most recent financial crisis from 2008 and 9, the loss impairment models only recognized credit losses as they occurred or after there was an evidence of default. So the International Accounting Standards Board issued a new accounting standard, the International Financial Reporting Standard 9, or IFRS 9, in July of 2014 to kind of get over this problem. And under this new process, the expected credit loss at ECL should be recognized at all times starting from the origination through the lifetime of the contract. And so the ECL is therefore recognized at each reporting month or date and is updated to reflect the changes in credit risk associated with that portfolio. And as part of this IFRS 9 requirement, macroeconomic indicators are included as parameters in the models that cover up the ECL calculation so that we can generate forward-looking estimates that will take into account any expected change in the macroeconomy and how that would be likely to influence our expected credit loss. So what is current expected credit loss? So the ECL calculation is shown in the slide. It is a product of our exposure at default or our cash flow with the probability of default, the loss given default or the severity, as well as the discount factor that takes into account the time value of money. The probability of default can further be broken down into its component factors, which are the probability of default historical, the probability of default macroeconomic, the probability of default with a performance adjustment, and a survival factor that takes into account the number of contracts that are currently existing in our portfolio. The PD macroeconomic can further be broken down as a product of the different macroeconomic variables that were significant in the PD macro model. Similarly, the LGD is a product of the different macroeconomic variables that were found to be significant in the LGD macro model. And each of these models are portfolio specific so that we can calculate the expected credit loss as a function of these risk metrics for different portfolios. So what is variance attribution? At its very simplest form, it is taking the difference in ECL between two reporting times, maybe 2 different months or 2 different quarters, and breaking that change in ECL into the underlying risk factors. So what the variance attribution allows us to do is identify the different risk factors and find out those factors that are most responsible, are the biggest drivers of change in ECL from one reporting time to another. And so these risk factors are shown in the pictorial on the left. So these include portfolio growth, change in the PD, and change in the LGD. And recall I had mentioned that the macroeconomic factors are a part of the PD and LGD change. So we can account for how macroeconomic changes will affect our ECL change from one time period to the other. We also take into account changes in the historical default rate and changes in days past due, or so that we can account for significant increase in credit risk as the accounts or a portion of the accounts become increasingly delinquent. So ECL variance methods can be classified or determined in different ways. There is the step-by-step method, the contract level method, and a weighted average method. The step-by-step method is the most comprehensive, but it's also computationally the most intensive because it requires us to change one risk factor at a time and calculate the ECL and attribute the ECL variance to that risk factor. But then we need to do this over and over again for every risk factor. So this is kind of the gold standard, but like I said, very computationally intensive. In addition, we have the contract level method, which is the most granular mathematical attribution that we can perform because it tracks all the changes in the ECL at a contract level. We also have the weighted average method, which is a more aggregate level methodology that can be used to calculate changes in the rate of default and severity, but not at a contract level, but rather at an aggregated segment, product, or business, or even at a portfolio level. So I'll be going over these 3 methods in the rest of my talk. So the contract level method basically takes the difference in ECL between times T1 and T2 and looks at the shared portion of the portfolio between times T1 and T2 and attributes them into the different factors. And these are shown by the yellow bars. And so the sum total of these 3 yellow bars would represent the change in ECL for the shared portion of the portfolio between T1 and T2. To this, we would add the change in the portfolio volume itself and how that affects our ECL. And so the sum total of all this would give us the attribution for the ECL change from time T1 and T2. So the first step that we worked with SAS to validate this contract level methodology was to compare the results that we get from this contract level method to the step-by-step or one at a time, changing one risk at a factor, and trying to demonstrate that the results from the 2 methods are comparable. So this slide here shows that when we change the risk factors, which are shown on the left, one at a time, we can obtain the results shown in the one at a time column. And when we perform the same analysis using the SAS collaborative contract level methodology, the slide here shows that our numbers were very similar. And importantly, all the directionality of the changes that we were attributing to the different risk factors are consistent between the 2 methods. So this gave us confidence that our contract level mathematical attribution is giving us the expected results as if we were changing one factor at a time, or very close to what we would get if we were changing one factor at a time. So this next slide here is just a very granular representation of how we can correlate the directionality of the changes in the macroeconomic factors with their contribution to the ECL. So on the left side, you will see a blue line and an orange line that show the unemployment rate at time T1 by the orange line and time T2 with the blue line. And you can see that around mid-2020, the two lines cross over. So after 2020 June, the unemployment rate is higher for T1 than T2. Whereas in the pre-2020 timeframe, you can see the blue line is higher than the orange line, showing that the T2 time period had a lower unemployment rate than the T1 time period. And so correspondingly, when we calculate the ECL for that is attributable to this unemployment rate change, you can see that pre-2020, there is a dip in the ECL, which is consistent with a lower ECL at time period 2. And post-2020, we see an uptick in the ECL variance, which is consistent with an increase in unemployment in time T2. So this also demonstrates that we can use the contract level analysis of ECL variance to get to ECL changes at a very granular level, which is what was shown in this slide. So one of the take-homes is that the ECL attributed to macroeconomic changes is intuitive, and it aligns with business expectations, and this happens even at a contract level. We can further aggregate this to a portfolio level and get the macroeconomic related changes in ECL for the portfolio. This next slide now shows how we can use the weighted average methodology to also come up with a similar ECL calculation and attribute the different risk factors in a method analogous to the contract level. So for the weighted average method, the ECL is a product of the sum of exposure or the cash flow times the weighted average life, which is the average number of years that are left to recover the principal outstanding amount. The weighted average PD, which is the PD of the portfolio or of the segment, depending on which level of analysis we are performing, but it's weighted by the outstanding balance. Then the weighted average LGD, which is LGD that is weighted by both the PD and the outstanding balance, and the weighted average discount factor, which is weighted by the exposure, the probability of default, as well as the loss given default. So using this weighted average method, we can calculate the ECL, and further, we can break down the weighted average LGD into a product of the weighted average macroeconomic factors that are in the LGD model. The weighted average PD can also be broken down into its component factors, and that being the historical baseline PD, the macro PD, which is the contribution of the macroeconomic variables to the PD model, a performance adjustment, and a weighted average survival, which takes into account the active portfolio that exists at each time period. This next slide here shows the different calculations that go into determining the components of the weighted average method for calculating ECL. So we would calculate the ECL for the two different time periods, and then take the difference in this ECL and attribute them to each of these contributing factors. So as shown in the next slide, we demonstrate in this slide an example of how the weighted average PDs can be calculated for a sample portfolio. So the slide here shows in dotted green lines the expected cash flows at a reporting time that are expected to flow out of the portfolio. So you can see the decrease as the cash flow contractual obligations are met. And the four solid lines here represent the four components that feed into calculating the weighted average PD. To begin with, we have the orange line, which is the baseline PD, and this is the PD that is expected to flow out of this portfolio based on historical default rates. But remember, in the IFRS9 CECL framework, we have a macroeconomic component that overlays or modifies this historical PD, and that is shown in the dark blue colored line, which is at the bottom, which is the bottom of the four curves that are shown in this graph. So the macroeconomic forecast is bringing down the expectation for the probability of default for this sample portfolio. In addition, we have a performance adjustment which allows for an overlay to this macroeconomic probability of default that makes it more in line with current defaults that are flowing out of that portfolio. And the last, which is the light blue line, is a representation of these PDs as they apply to an active portfolio. So all the contracts that are active at the reporting month for which this calculation was performed. So, so this gives us a nice representation of how the weighted average PDs change over the time horizon for the ECL calculation. This next slide shows the weighted average LGD curve for the sample portfolio, and you can see that there is, as the macroeconomic scenario or the macroeconomic forecast changes in the forecast horizon, the weighted average LGD also responds to that change in the macroeconomic conditions, and we don't see a flat line, but rather a gently rolling line that represents the weighted average LGDs as they come out of this portfolio through the time horizon that we are forecasting the LGD for. So this slide here shows a comparison of the weighted average and the contract level methodology. And the big take-homes here are that the two methods are very similar in their attribution. However, they are not identical. And part of the reason for this is that the SAS collaborative effort that we performed for the contract level variance attribution mostly focuses on the shared portion of the portfolio in terms of breaking down by the different PD risk factors and the different LGD risk factors, whereas the weighted average methodology can be used to just look at the entire portfolio at these two different time frames and calculate the different risk factors that are acting on the portfolio at the two different times. So we see some differences in the values attributable to the different risk factors. However, the directionality of the change is quite consistent. So in conclusion, this slide here compares the advantages of the two different methods, the contract level and the weighted average methodology for ECL variance attribution. So one of the advantages of the contract level method is that it's very comprehensive. We can drill down to each primary component, the PD, LGD, EAD. We can also isolate portfolio effects, which are due to change in the portfolio or change in the aging of the portfolio, and separate them from the PD and LGD factors. Of course, because it's a contract level methodology, it is very granular. And so it also allows us to figure out if there's any data issues which are associated with certain groups of contracts, and allows you to track and fix them accordingly. Also, I didn't talk about this, but staging or significant increase in credit risk is part of the IFRS9 methodology, and the contract level method can track contracts as they go from one stage to the other because of change in their delinquency. And in contrast, the weighted average method can provide us with certain other insights into the ECL variance, one of them being that we can calculate the macroeconomic impact on the portfolio at two different time points, regardless of whether the portfolio is shared or unique to one or the other time period. Also, the weighted average methodology is quantitative because it's a portfolio level calculation. So we have the ability to extract portfolio level PD and LGD rates between two different forecasting months and compare the values. So the key takeaways from this very productive collaborative effort that we had with the SAS team is that business needs to track changes in ECL under these new regulatory framework. And we need to be able to attribute changes in ECL into portfolio, LGD, PD risk factors so that we can help explain to business, what the main drivers of variance are from one reporting date to the next. Also, because we have incorporated macroeconomic forecasts in the ECL, we can look at different scenarios for downturn and upturn forecasts into the future, and this allows us to provide quantitative numbers to finance for the expected credit loss under different scenarios, and this allows them to anticipate the magnitude of change in allowances that could potentially happen when the macroeconomic conditions change, and gives them the ability to allocate capital accordingly. So with that, I would like to end my presentation, and I thank you all for your attention, and I thank SAS Chia for this chance to present to the audience. Thank you so much.